Our next session is on the not unimportant question of what private equity's preferred exit routes are right now. To oversee this discussion, it's my great pleasure to introduce Greg Gilles, Publishing Editor, Growing Business Intelligence, Real Deals Media.
What a mouthful. Thank you very much, Tim. Thank you very much, everyone, for being here for this panel. I know it's a bit late in the day, but aren't you glad you stuck around? Because it's going to be great. We're welcoming you to this panel, which is focusing on the exit environment for GPs in the current cycle. So we've all sat through really interesting discussions today, and I think we can all agree that it's not going to be smooth sailing, and volatility and uncertainty is certainly on the cards for the next few months. And deal flow is obviously one of the main areas that are going to be impacted. What does that mean for divestments, specifically for GPs? You all know as well that 2021 was actually a record year for exits in Europe and worldwide, but already there are signs that 2022 is starting on a much weaker footing. So global exit value reached $338 billion in the first 6 months of 2022, according to Dealogic data, and that's down 37% year on year. And when we look at IPOs, which are a massive driver of exit values, PitchBook counted only 8 PE-backed IPOs in Europe in the first half of the year, and it compares with 133 last year. So it's a very challenging picture indeed, but even in the good years prior to 2022, I think we all agreed that just the quick cycles of windows opening and closing very quickly meant that exit planning was actually not always straightforward. So luckily, to make sense of all that, we've got a great panel with us today. So I'll let you all introduce yourselves, and then we can get stuck in, starting with you, Nicola.
Okay, happy to start. Hi, everyone. Sorry, I can't really see you. The light is very strong, but I see there was a good crowd, and nice to be with you. My name is Nicolas Bruger. I'm the head of France for EQT and a partner in the private equity fund.
Hi, everybody. I'm Barna Baravanne. I'm the Chief Investment Officer of FSI. FSI is a pure play growth equity fund based in Italy. We do mostly sector-wise technology and healthcare. And in terms of the business model that we have, we do partnership investment, which we actually do in the form predominantly of minority with hands-on governance. And that's very relevant when it comes to management appointment and exit, which is the topic of today indeed.
Good afternoon, everybody. Like you, the light is just, I don't know if you can do something against the light so that I have the impression to be in a police office. So my name is Jean Eichenlaub. My name is Jean Eichenlaub. Again, yes, like yesterday. We said nothing about last night. So nice to meet you all. I'm Jean Eichenlaub. I'm the chairman of Qualium Investissement, 1.2 billion assets under management, French mid-cap fund.
And as you're the last one to be speaking, Jean, I'll start with you. So are we in a buyer's market now? And does that mean that you're approaching exit timescales differently when you look at a portfolio?
Yeah, the question was now, right? Mm-hmm. What are the changes now? I guess just to give you maybe some numbers on some mathematics on our market. We're talking in France, the mid market is about 200 deals per year, so that's 200 sellers and 200 buyers on the market in the private equity, and there are really two exit routes. I would say the number one is private equity selling to private equity. And for us, what we've experienced over the years is doing private equity, our type of funds, which I try to qualify sometimes for those of you like football, like League One in France, that you sell the companies to Champions League, to bigger funds, usually UK funds, US funds, who are going to bring the company to a next stage. Our job is to, when we make investments, we invest in companies between 8 to 20 million euros of EBITDA, and the objective is to double the EBITDA over the holding period, structure the company, start an ESG policy, and then have an asset who is going to be of interest for these bigger funds. What we do during the period, we usually help the companies to become European or more European, and the bigger fund will bring the company to another stage, which will be probably more global, more worldwide. So that's, I would say, the preferred route today, and for our cases, for example, is the most logical exit. But you have to do the work, and you have to do the structuring of the company so that the company really becomes interesting for somebody who afterwards has got other ambitions. The second exit route would be to strategic players, which we do less. I would say out of the 200 deals in France, there must be 15% who are sold to strategic, to industrial players. It's less the case. It can be the case when you really transform the asset and you make it something essential for these big groups to buy it. Or for big industrial players, for example. We've seen the example on one of the exits that we did recently, which was a French business school called EM Lyon. When you turn the company around to what is interesting for one big group in the education worldwide, it is strategic for them to make these kind of acquisitions. So that's, I would say, is the second exit route. And the third one, which is the easiest one, which is zero, which is IPOs. In our market in France, frankly, been in this business for 22 years, IPO is not a call, not an exit route for us.
How does that tie in with what you see at EQT, Nicolas?
Look, I think it's pretty consistent. Looking back at the past 2 years, I think COVID, besides being a tragic health crisis, was a big reminder that volatility has not disappeared, and we see that again today. Meaning that nothing is for granted, and whenever you have a good exit window, it's important to take it. So I think reflecting on that, there was a very good exit window in 2021, with a lot of liquidity on the market, high valuation. So we equity as a firm realized a lot in 2021. I think the total number of realizations announced was 38 billion euros, so a massive exit. Obviously, it has slowed down a bit with the new environment, but I think we intend to keep pushing. We see a big benefit in having a young portfolio. I think whenever you exit, you free up time to take care of the other more recent portfolio companies and also to work on new deals. So I think the market is more difficult. Back to your point on IPO, we don't do much IPO. It's not our preferred exit route. We can do some of them. We IPO'd Azelis in Belgium last year, which was a significant IPO. SUSE, a software company in Germany. But to do an IPO, you need a very strong growth case. You need to make sure that the company will fit with the public market and that you can find your liquidity along the way, which is sometimes difficult with overhang. So going forward, we keep working mainly on trade exit, sponsor exit, and to a lesser extent IPO whenever the market would reopen.
That's great. I'm sure we'll come on some of these routes later on. We see how they're impacted by the current environment, perhaps differently. But Barnaba, perhaps you could tell us a little bit from your perspective as a minority investor, which is quite interesting, quite different to these gentlemen's strategies. What does your exit avenue, your portfolio of exit route, what that would have looked like maybe 2 years ago? Is that different now?
Thank you, Greg. Well, in terms of exit, we've been very busy over the last 12 months. We managed to exit a third of the portfolio, top quartile return, luckily. For us, from the start of the making of the minority investment, the work is to turn at exit that minority stake into a sale of 100% of the business. There is a cushion, obviously, in terms of valuation when you get in as a minority investor. And throughout the cycle, you can find opportunities to realize a positive spread when you go for 100% sale. To do that, you need a strong contract, which is important, but also to nurture and develop the relationship with the other investor, across whatever happens. And I think the pandemic and all the challenges have been able to bring together the majority and the minority investor in working together. And I think if you're able to do that, you get prepared to that very, very important event, which is important for us as a private equity fund, but is probably even more important for a family that might be the controlling shareholder, because that's all they have. So that preparation, I think, is very crucial in minority investing. And I would say compared to buyout investing, it's probably you have more chances to find the window because of the arbitrage that you can extract. It's very important when you are a minority investor to have a process when you sell where you can position the buyer as the best owner of the asset for whatever it means. I mean, not just the one that is paying the highest price, but the one that is caring for the family that is, giving the asset to somebody else that can do better with the business in many ways, ESG as well. And with that work, then all stars are aligned and you can extract, I think, good value also in current times. We do not rely very much on secondary buyouts, not much on IPO because the family will have to care, to carry the burden going forward. So it's mostly strategic exit to the best buyer that we actually look for and that we have been looking for, historically, luckily with a good degree of success.
And you said you've had a really, really good sort of past 12 months. In other words, have you started to see a bit of a shift in, specifically when it comes to strategics? Obviously, they're facing their own constraints in terms of their planning and their ability to kind of raise leverage and that sort of thing for M&A. Has that had an impact yet? Do you still see for the right asset? Do you still see the right level of appetite? That means, a good outcome for you and the families that you back?
Yeah. Well, we are the largest fund in Italy. We are 1.5 billion. So on the mid-market, we managed to have access to assets that are quite unique. So for those assets, there is strong appetite from industrial buyers coming, into the country or for other players of the Italian market to get stronger or to get into a segment, a niche where Italian businesses are particularly strong. In that case, actually, we see that strategics see better chances now to buy the asset that they want compared to maybe, before the pandemic when the leverage was really high and the competition from a private equity fund was very significant. So now, they have their chance. In our case, given there are families also involved, you need to build a relationship between the new buyer and the family itself to sell it. You don't just push a button. So we do find a lot of motivated strategic that are keen and paying, the synergies at least that they obviously you would expect them to pay.
It's very good news. And Jean, you're going to jump on that.
I would agree on the strategics. They can pay a premium compared to the funds, but it's not the same rhythm. It would take much longer. Due diligence would be probably more detailed. They are back on the market now, like you guys did. We had the best ever years for the last 2 years in terms of exits, selling to some strategics, some listed companies in the US and one in the UK. It takes more time. They can pay a premium of 1 to 2 notches compared to PE shops, but it will take more time. And if you have the time, like we said, we're not, and they pay the synergies, which is good for the funds.
But I think, you would argue, is it this the right time? I mean, we have to put the work, right? We get our management fee. So I think it's normal that at some point in time we have to work harder, right? To be more patient. It takes longer. Maybe 2 years ago it was too easy, right? So it's part of our job. It's part of what we do. And I think what we're going to be able to show in this challenging time is, what's going to make the difference going forward, right?
And no doubt we'll come back to the issue or the opportunity of time down the line as well. But Jean, were you on this? Because obviously you mentioned that your model is kind of moving up the ranks of private equity as it goes on for the assets. Have you noticed a bit of a step change when it comes to secondary buyout opportunities from what you've done recently, from what you're currently looking at, given the changing availability of leverage, but at the same time, funds still have massive amounts of capital to deploy. Is the net effect that it's still kind of as it goes for secondary buyout opportunities?
I'm going to do a bit of advertising for one of my colleagues from Argos Soditic. There is an index in France who gives you the multiples, the exit multiples.
Very useful publication.
It has decreased a little bit, but frankly, Not a lot. There is a lot of equity available, I would say, for the bigger funds who are above us, who are our, say, natural buyers. In terms of debt, in France at least, yes, the banks are much more cautious, I would say. Some of them have stopped. But on the other hand, there has been a lot of money raised by funds, by debt funds. Private debt is in France, was unknown 15 years ago. I think even the word didn't exist 10 years ago. Right now, there are private debt funds in France, extremely active, extremely competent, extremely good. So you can still lever a company at 4, 5, 6 times EBITDA, not too much capex, at 6 times. But yes, you can still find debt. So for the moment, at least, in terms of prices, the average is 11 times, 11.5 times today in the mid-cap in France, average prices for the companies. So you're still, at least for the moment, not, it hasn't changed too much, I would say. But I would anticipate, normally it should, because the spreads have increased, the leverage is, maybe we lost one notch, so it should have an impact on the prices of the assets. But in reality, as of today, it's mainly the opposite. It has even increased a little bit. So on the good assets. So it's difficult to predict what's going to be the impact on the pricing. The logic would be that it should go down, but we've been saying this for years. Except 2008, it has not really happened. No?
Maybe I can comment for the larger cap. On financing, there's clearly a slowdown. So indeed, you can get liquidity from private funds, but above €1 billion of EV, you just have a few players that can really provide financing. The bond market is de facto closed, and I think it's difficult for term loans as well, right? So because of that, I think the number of deals coming to market has come down. There's clearly a slowdown due to the uncertainty. And when there's a good asset coming to market that can be financed because the size is right, for instance, I think there's still a lot of demand and competition. As you said, there's a lot of capital available in the funds. So it's unclear that you can already see in the market discount on what the valuation were.
Does that mean that when it comes to the assets that you have in your portfolio that would be the right fit for a secondary buyout, do you still think it's probably the way to go given the environment, or do you see, much like Barnaba, do you still see strategic appetite for some of your assets?
Yeah, it's a bit on a case-by-case basis, right? You know at entry, whenever you might have a strategic sale, right, and trade interest, especially for larger deals, it's not that you have 30 different strategic buyers. So that's something you want to work on very early on in a deal. I think in France, around 70% of the market is secondary, so that remains a big source of liquidity for exit. But whenever we can sell at a good valuation to a trade, we do. Yeah.
And there is an elephant in the room there that we haven't talked about. We talked about a few different exit routes, but there's one that we didn't mention, which is obviously just keeping the assets. What would you sell them? I know that when we talked before, I don't think none of you have been sort of all in on the sort of GP-led continuation craze, but at the same time, I think it's a trend that resonated with you in the sense of backing your winners for longer. And I think that's always been the case for everyone. That's why that continuation fund, partly why the continuation fund craze has been so popular. But perhaps you could talk a little bit about that and how you approach that challenge, whether it's perhaps reinvesting from a follow-up fund or just any other kind of ways that you found to back your winners for longer. Nicolas, actually, do you want to start?
Yeah, and look, maybe I will start making the case for exit, right? And why it also makes sense to exit after a short period of time, call it 4 years. Well, I think first it gives a good sense of urgency as an active owner, no procrastination, you need to act now. That's not short-termism, but it means you will take the actions early on that will create long-term value. That can be add-on M&A, that can be digitalization, that can be the sustainability agenda. So I think that there's a merit in knowing that you will have to exit early. Second, obviously, that's still the best way to provide liquidity to our LPs, and some of them want cash back. It's also a way to provide liquidity to the team, and when the performance is good, carried interest, which is in the people business important to attract and retain the best talents. and I think that last, as I mentioned at the beginning, it's good to have a young portfolio, right? We look a lot at EQT, at the ratio of portfolio company to partners. And I think whenever you have a long tail of underperforming assets that you have kept for longer, it takes time on new deals and creating value on the best companies, right? So, maybe start with that. That being said, there's also a case to ride the winners,
and we are super good assets.
Yeah, we're trying to do that as well. The way we do it at EQT, we don't use continuation fund, but in some instances, we can buy, as part of a competitive process, an EQT portfolio company with another equity fund, right? And in general, a minority investor would come alongside us to set the price. So I think one very relevant example is our Swedish enterprise software company IFS, which was an equity 7 deal back in 2015. And then it got acquired by Equity 8 and Equity 9 together with TA as a minority shareholder. Now it's only with Equity 9 and TA. It has been a very good deal for Equity 7, very good deal for Equity 8, and it will likely be a very good deal for Equity 9. So yes, when you surf a fantastic wave, you don't want to step out early on, and that's a way to keep the exposure for our LPs.
Just to play devil's advocate, perhaps there a little bit. It's sometimes people have associated that with LPs being perhaps rumbling a little bit about assets being carried on like this without the optionality perhaps of getting out. Is that if you had a pushback like this, and how do you deal with that, or is everyone just happy to back the winners?
I think what's important for LP is to make sure that they get the best possible price out of the exit process. So we are very mindful of that. And then some LPs can be willing to invest in longer haul strategy, right? So pension funds or some family offices. So there's also a case, and I think a market for longer term funds. We have Equity Future, for instance, in the private equity, private capital business of EQT or infra funds. And then you can remain exposed without the leakage of transaction fees, and it makes some sense, right? Otherwise, I see a case for exiting after 4 years on average for the reason I explained. Yeah.
What about you? I was going to go with Barnaba, but Barnaba, how about
I was just thinking that the two, we looked at two of them. You've got to have a real story to tell to your LPs, right? Because they're a little bit skeptical about.
Do you mean continuation funds or backing through? Okay.
Continuation funds. That's number one. There has to be a real story. Plus, there has to be the right price. At the end of the day, we didn't do it. We did a deal with Permira where we came in. We became minority holder in the second deal, and Permira became the majority owner. That's number one. Number two, you cannot fail on a deal like this, because if you put money back on the deal, it's at a usually much higher value compared to what you bought it before. It is a little bit more, I would say, a bit more risky than a normal deal, I would say, from my point of view. On the other hand, it's always something you want to do when you have a fabulous assets in your portfolio. You want to roll it over. Some guys on fund 1, 2, 3, 4, they still have these assets in the portfolio and they made fortunes out of it. So it's a difficult game, but I think it's a tendency of the markets. I think it's happening in the US like huge time, from what I know at least. And I think it's going to happen in Europe. So be ready for this change of the market, because I think it's going to happen at least in the French market. That's from what I know.
Does that mean that you've let go of assets that you wish you held on to? Does that mean that you let go of assets that you wish you held on to?
No, but for excellent assets, you could keep, like you said, you would have family offices or long-term investors. They come in our funds all the time, so they would look at you. You can hold an asset for 10 or 15 years. When the asset grows 10-15% per year, it's a fabulous asset to be in your funds. But then, the downside is you better don't fail, because if not, you will be more criticized than if you make a mistake on a more traditional deal, I would say.
Fair enough. And Barnaba, the minority investing, you must throw a quite interesting range there if you want to hold on for longer.
Well, we think that the theme of backing winners for longer is core in minority investing. as a minority investor, we get access to an asset that is not available for a sale for 100% yet. We come in, we grow the business with the partner, and then 3 years down the road, there is the opportunity to crystallize for everybody a sale of 100%. At that point, the asset is still very good. It does have a lot to give with a new owner. And the new owner, it's often the case that will want a partner. So with our business model, the differentiating factor is to be able to partner with many market participants. They can be family, they can be banks that own IT consortium, for example, but they don't know what to do with. It can be private equity funds, or it can be corporate as well. Corporate that come into a country from another continent might want a partner. So with the minority investing business model, you can stay as long as you bring value to the partner attached to a good asset that you have identified in the first place and you made better for a phase of growth for the second phase. As far as we are concerned, we've done this twice last year. In one case, we were partnered with 15 Italian banks on an IT fintech business. And then it got sold to a strategic that came into Italy, and they wanted, because of regulatory reason as well, and many other things, a local partner. So we're carrying on with them with a structure exit clearly. We have done that with larger PE fund like they did. And I think it is an opportunity that our business model is presenting more and more. It's very, very important that you have no ego, right, to do that. So you're partnered with one, you can be partnered with the other, and then you create value together, and you can make money for the LP for a longer time.
Absolutely. Do you tend to do that can you do that from the same fund? Does it tend to be kind of subsequent generations of fund?
We have done that from the same fund, making it clear that it was a different investment because the governance was different. So for us is crucial the governance we put in place in a deal or in another. In deals where we have less governance, then we have better economics, maybe not necessarily pari passu with the other party.
Fantastic. And I think this is all the time we have for, and wrapped up right in time. Thank you all for being there and talking about that today. And thank you everyone for being in the room as well. Thank you.
Thank you.